PFRS for Small and Medium-Sized Entities, Part 2. Section 21, Provision and Contingencies. Initial recognition. An entity shall recognize a provision only when the entity has a present obligation at the reporting date as a result of a past event or it is probable that the entity will require to transfer economic benefits in settlement and the amount can be estimated reliably. Present obligation arise either from legal obligation or constructive obligation, resulting from the past events. Obligation that arise from entity future action do not give to rise to present obligation no matter how likely they are to occur and even if they are contractual. Initial measurement. An entity shall measure a provision at the best estimate of the amount required to settle the obligation at the reporting date. When the provision arises from a single obligation, the individual most likely outcome may be the estimate 2 of the amount required to be settled obligation. Reimbursement. When a portion or the entire amount required to settle a provision may be reimbursed by another party, the entity shall recognize the reimbursement as a separate asset only when it is virtually certain. Contingent liabilities. It is either possible but uncertain obligation or a present obligation that is not recognized. Contingent liability is only possible obligation, ibig sabihin hindi siya probable. Present obligation but it is not recognized because it is not probable or the amount of obligation is not measurable reliably. So, ibig sabihin hindi siya tumutugma sa criteria ng liability. Contingent liability, this will be only disclosed on the books, not recognized. Contingent asset shall not be recognized as asset but disclosed only if they are probable. Section 22. Liabilities and equity. A liability is a present obligation of the entity arising from past event, the settlement of which is expected to result in an outflow from the entity of resources embodying economic benefits. An instrument is liability if the issuer could be required to pay in cash. Equity is the residual interest in the asset of an entity after deducting all its liability. Instrument classified as equity. A putable instrument is financial instrument that gives the holder the right to sell the instrument back to the issuer or it's automatically redeemed by the issuer on the occurrence of an uncertain future event or the death or retirement of the instrument holder. Instrument classified as liability. Instrument is classified as liability if distribution of net asset on liquidation is subject to maximum amount. A putable instrument is classified as equity if when the put option is exercised, the holder receive a pro rata share of net asset of equity. Classification as equity if it obliges the entity to make payment to the holder before liquidation. D. Instrument that is classified as an equity in subsidiary financial statement is classified liability in the group consolidated group financial statement. Classification of financial instrument as liability or equity. A rule of thumb, if the issuing entity is obliged under the term of instruments to settle the instrument regardless of whatever or not the entity is under liquidation, the instrument is classified as liability and not equity. An entity shall measure equity instrument at the fair value of cash. If the payment is deferred and the time value of money is material, the initial measurement shall be present value. Capitalization or bonus issue of share and split. Issue of new share to shareholder is proportion to their existing holding. A share split is the dividing of an entity existing share into multiple shares. Capital and bonus issue and share split do not change total equity. Convertible debt or similar compound financial statement. On issuing convertible debt or similar compound financial instrument that contain liability and equity component, an entity shall allocate the proceeds between the liability component and the equity component. Extinguish financial liabilities with equity instrument. A. Fair value of the equity instrument issue, or B. Fair value of the liability and extinguish. Treasury share. Treasury share are the equity instrument of an entity that have been issued and subsequently required by the entity. Distribution to the owner. Dividends declared shall be recognized as reduction in equity. Property dividends. The liability of property dividends is measured at the fair value unless value cannot be measured reliably. 23. Revenue. Revenue arises from the following transaction: A. Sale of goods, B. Rendering of services, C. Construction contract, in which the entity is the contractor, D. Use by the other of entity asset, yielding the interest, royalties, or dividends. Measurement. Revenue is measured at fair value of the consideration received or receivable, taking into action any trade discount, prompt discount, and volume rebates allowed by the entity. Amount collected on behalf of third parties, such as sale, taxes, and value-added tax, shall be excluded from the revenue. Deferred payment. When the inflow of cash or cash equivalents is deferred, and the agreement constitutes in effect a financing transaction, the fair value of the consideration is the present value of all future receipts, determined using an imputed rate of interest. A financing transaction arises when, for example, an entity provides interest-free credit to the buyer or accept a note receivable bearing a below-market interest rate from the buyer as consideration for the sale of goods. The input rate of interest is the more clearly determinable of either a prevailing rate for a similar instruction of an issuer with a similar credit rating, or B. a rate of interest that discount the nominal amount of the instrument to the current cash sale price of the goods or services. And also, deferred payment. A. Provides interest-free credit to the buyer. B. Accept a note receivable bearing a below-market interest rate. Customer loyalty program. Sometimes, as part of a sale transaction, an entity grants its customer a loyalty award that the customer may redeem in the future for free or discounted goods or services. In this case, the entity shall account for the award credits as separately identifiable components of the initial sales transaction. The entity shall allocate the fair value of the consideration received or receivable in respect of the initial sale between the award credit and the other components of the sale. The consideration allocated to the award credit shall be measured by reference to their fair value, the amount for which the award credit could be sold separately. Sale of goods. Revenue from the sale of goods is recognized when all the following conditions are satisfied. A. The entity has transferred to the buyer the significant risk and reward of the ownership of the goods. B. The entity retains neither continuing managerial involvement to the degree usually associated with ownership nor effective control over the goods sold. C. The amount of revenue can be measured reliably. D. It is probable that the economic benefits associated with the transaction will flow the entity. E. The cost incurred or to be incurred in the respect of the transaction can be measured reliably. An entity does not revenue if it retains significant ownership. Following are examples of situation in which an entity may retain the significant risks and rewards. A. When the entity retains obligation for unsatisfactory performance not covered by normal warranties. B. When the receipt of the revenue is contingent. C. When the goods are shipped subject to installation and the installation is a significant part of contract. D. When the buyer has the right to rescind the purchase. If an entity retains only a significant risk of ownership, the transaction is a sale and the entity recognizes the revenue. Revenue is recognized when A. The seller retains legal title to the goods to protect collectability of the amount due. Or B. Seller offers a refund if the goods are faulty or customer is not satisfied for other reason. The entity can estimate the returns reliably. A provision should be recognized for the estimate returns. Rendering of services. When the outcome of transaction involving the rendering of services can be estimated reliably. An entity should recognize revenue associated with the transaction by reference to the stage of completion of the transaction at the reporting period. The outcome can be estimated reliably when all the following conditions are satisfied. A. Amount of revenue can be measured reliably. B. Economic benefits associated with the transaction will flow to the entity. C. Stage of completion at the end of reporting period can be measured reliably. When services are performed by an intermediate number over a specific period of time, entity recognizes revenue on a straight line basis. Over the specific period, unless there is evidence that some other method better represents the stage of completion. When outcome of transaction cannot be estimated reliably, entity shall recognize revenue only to the extent of the expense recognition that are recoverable, unless this is clear from substance of contract that construction contract are to be treated as a single group. Construction contract. Contract revenue and contract costs are recognized as revenue and expense. Using percentage of completion method, each construction contract shall be accounted for separately. Construction of each asset shall be treated as separate construction when A. Separate proposal have been submitted for each asset. B. Each asset has been subjected to separate negotiable and the contractor and customer are able to accept or reject the part of contracting relating to each asset. C. Costs and revenues can be identified. A group of contract shall be treated as a single construction when A. Group of contract is negotiated as single package. B. Contracts are so closely interrelated that they are in effect part of single project with overall margin profit. C. Contracts are performed currently or in a continuous sequence. Percentage of completion method. Revenue and expenses are recognized based on estimated percentage of service being rendered or construction contract. For example, a 50% complete construction contract would result to recognition of 50% revenues and expenses from the contracts. Possible methods include a ratio of cost incurred for work performance to date over the estimate total cost. For example, if the total cost incurred to date is 100 and the total estimate construction cost is 200, then the percentage of completion is 50%. Costs incurred for work performed to date do not include costs relating to future activities, such as material or prepayments. B. Surveys of work performed. C. Completion for a physical proportion of the service transaction or contract work. When outcome of construction contract cannot be estimated reliably. A. Revenue shall be recognized only to the extent of contract cost incurred that is probable will be recoverable, and B. Contract costs are recognized as expense in period in which they are incurred. Interest, royalties, and dividends. Revenue shall be recognized on the following basis. A. Interest shall be recognized using effective interest method. B. Royalty shall be recognized on accrual basis in accordance with substance. C. Dividends shall be recognized when shareholders' right to receive payments is established. Section 24. Government grants. Government grants means assistance by government in the form of transfer of resources to an entity in return for past or future compliance with specified conditions relating to the operating activities of the entity. Government grants exclude the following. A. Government assistance that cannot reasonably have value placed upon them. So dito, take note that government grants has a value amount that can be stated. So pag walang value, exclude. B. Transaction with government that cannot be distinguished from the normal trading transaction of the entity. C. Income tax, holiday, investment tax, credit, accelerated depreciation allowances, and reduced income tax rate. Recognition and measurement. Government grants are recognized as follows. A grant that does not impose specified future performance condition on the recipient is recognized in income only when the grants proceeds are receivable. B. Grant that impose specified future performance condition on the recipient is recognized in income only when the performance conditions are met. C. Grant received before the revenue recognition criteria are satisfied are recognized as a liability. Government grants are measured at fair value of the asset received or receivable. Section 25. Borrowing costs. Interest and other costs that an entity incurs in connection with the following borrowing of funds. Borrowing costs include A. Interest expense calculated using the effective interest method. B. Finance charge in respect of finance lease. C. Exchange differences arising from foreign currency. Recognition. All borrowing costs are recognized as expense in profit or loss in the period which they are incurred. Under full PFRS, borrowing cost is capitalized, but in PFRS for SMES, they recognize as expense not capitalized.
Section 26. Share-based payment. Share-based payment include the following. First, equity-settled share-based payment. Transaction in which the entity acquires goods or services as consideration for equity instrument of the entity, including shares or share options. Next is cash-settled share-based payment. Transaction in which the entity acquires goods or services by incurring liabilities to the supplier of those goods or services for amounts that are based on the price or value of the entity, shares, or other equity instrument of the entity. And last, transaction which provides either the entity acquiring or supplying goods or service. The choice between settlement in equity and settlement in cash. Also, in cash settled share-based payment, transactions include share appreciation rights. Next is recognition. The goods or services received or acquired in share-based payment transaction are recognized when the goods are obtained or as the service are received. The entity recognizes a corresponding. First, liability. If the goods or service acquired in the cash settled share-based payment transaction. Next is increase in equity. If the goods or services were received in an equity settled share-based payment transaction. When the goods or services received or acquired in a share-based payment transaction do not qualify for recognition as asset, they shall be recognized as expense. Recognition when there are vesting conditions. If the share-based payment granted to employees vests immediately, service are recognized as expense in full on grant date, which corresponding increase in equity or liability. Share-based payment granted to employees vests immediately if the employee is not required to complete a specified period of service before becoming unconditionally entitled to those share-based payments. If the share-based payment do not vest until the employee completes a specified period of service, the service received are recognized as expense over the vesting period, with a corresponding increase in equity or liability. Measurement of equity settled share-based payment transactions. The goods or service received from non-employees under equity settled share-based payment transaction and the corresponding increase in equity are measured using the following order of priority. First, fair value of goods or services received. Next is fair value at equity security issued or granted. If the fair value of goods or service received cannot be estimated reliably. Transactions with employees and other providing similar services. Goods or service received from employees and other providing similar service under equity settled share-based payment transaction and the corresponding increase in equity are measured by the reference to the fair value of the equity instrument issued or granted. This is because typically it is not possible to estimate reliably the fair value of the service received. For transactions with employees, including others providing similar services, the fair value of the equity instrument shall be measured at grant date. For transaction with non-employees, the measurement date is the date when the entity obtains the goods or the counterparty renders service. Next, vesting conditions. A grant of equity instrument might be conditional on employees satisfying specified vesting condition. Vesting condition might be related to any or a combination of the following. First, service condition. The grant of equity instrument is conditional on the employee remaining in the entity's employ for a specified period of time. Next, performance condition. The grant of equity instrument is conditional on the accomplishment of a pre-agreed performance. Condition may be non-market vesting condition or market vesting condition. Non-market vesting conditions such as the entity achieving a specified growth in profit. Next, or market vesting condition such as the attainment of specified increase in the entity's share price. Measurement. The fair value of shares or share option and equity settled share appreciation rights are measured using the following three-tier measurement. First, if an observable market price is available for the equity instrument granted, use that price. Next is entity specific observable market data. If an observable market price is not available, measure the fair value of the equity measurement granted using the entity-specific observable market data, such as recent transaction in the entity's shares or recent independent fair valuation or its principal assets. Next is, if A and B are not available, use the following. The fair value of the shares or share appreciation rights shall be indirectly measured using a valuation method that uses market data to the greatest extent practicable to estimate what the price of those equity instruments will be on the grant date in an arm's length transaction between knowledgeable willing parties. And next, use the other option, which is option pricing model. The fair value of option or share appreciation right using option pricing model. Next, modification to the terms and condition. The entity shall take the modified vesting condition into account in accounting for the share-based transaction as follows. A. If fair value of equity instrument increase, the entity shall include incremental fair value. If the modification increase the fair value of the equity instrument granted, measured immediately before and after the modification, the entity shall include the incremental fair value granted in the measurement of the amount recognized for service received as consideration for the equity instrument grant. The incremental fair value granted is the difference between the fair value of the modified equity instrument and that of the original equity instrument, both estimated as the date of the modification. The incremental fair value granted is recognized as additional expense over the remaining vesting period as of modification date. B. If not beneficial to the employee such that the modification decrease the fair value of the equity instrument, the modification is simply ignored. Next, cash settled share-based payment transactions. The goods or service acquired and the liability incurred under the cash settled share-based payment transaction is measured at fair value of the liability. Until the liability is settled, subsequent fair value changes are recognized in profit or loss. Now, share-based payment transaction with cash alternatives. Either entity or the counterparty that provides choice of settlement in cash or in equity instrument are accounted for a cash settled share-based payment transaction unless either A. Past practice of settling by issuing equity instruments. B. Has no commercial substance because the cash settlement amount bears no relation to and it's likely to be lower in value than the fair value of the equity instrument. In circumstances A and B, the transaction should be accounted for equity settled share-based payment transaction. Now, Section 27, Impairment Loss. An impairment loss occurs when the carrying amount of an asset exceeds its recoverable amount. Impairment of inventories, where the carrying amount of inventory exceeds the recoverable amount. The difference between carrying amount and selling price less cost to complete and sell shall be recognized as impairment loss. Selling price less cost to complete and sell shall be determined for inventories item by item unless it is impracticable. It is impracticable inventories relating to the same product line that have similar purposes or end uses and are produced and marketed in the same geographical area may be grouped for the purpose of assessing impairment. Now, reversal of impairment of inventories. New assessment of selling price less cost to complete and sell for inventories shall be made at each subsequent reporting date. If previous inventories no longer exist, the impairment loss shall be reversed as gain on impairment recovery. Next, impairment of assets other than inventories. When recoverable amount of an asset is less than its carrying amount, asset's carrying amount shall be reduced to recoverable amount. The reduction is an impairment loss which shall be recognized immediately in profit or loss. However, when the asset is measured under the revaluation model, the decrease in value is recognized in other comprehensive income and treated as a reduction in that asset revaluation surplus. Indicators of impairment. Assessments shall be made to each reporting date for indication that asset may be impaired. If any such indication exists, the recoverable amount of the asset shall be estimated. If there is no indication of impairment, an estimate of the recoverable amount is not necessary. If it is not possible to estimate the recoverable amount of the individual asset, an estimate of the recoverable amount of the cash generating unit or CGU to which the asset belongs shall be made. This may be the case because measuring recoverable amount requires forecasting cash flow, and sometimes individual assets do not generate cash flow by themselves. Now, following indications shall be considered in assessing whether an asset may be impaired. 1. External source of information. A. Significant decline in market value than what is expected as a result of passage of time or normal use. B. Significant changes in technological, market, economic, or legal environment in which the entity operates or in the market to which an asset is dedicated. C. Increase in market interest or market rates of return on investment, which are likely to affect discount rate used in calculating assets value in use and decrease asset recoverable amount materially. And D. Carrying amount of the net assets is more than its market capitalization. Now, number 2, the internal source of information. A. Evidence of obsolescence of physical damage. B. Significant change with adverse effect to the entity has taken place or will take place, which will affect expected use of asset, discontinue, disposal, etc. And C. Evidence is available from internal reporting that indicates that the economic performance of asset is or will be worse than expected. Now, measuring recoverable amount. Recoverable amount of asset or cash generating unit is higher of its fair value less cost to sale and its value in use. It is not always necessary to determine both an asset fair value less cost to sale and its value in use. If either of these amount exceeds the asset's carrying amount, the asset is not impaired and it is not necessary to estimate the other amount. Fair value less cost to sale is the amount obtainable from the sale of an asset in arm's length transaction between knowledgeable willing parties less the cost of disposal. Next, value in use is the present value of the future cash flow expected to derive from an asset. Estimating value in use of an asset involves the following steps. First, estimating future cash inflows and outflows to be derived from continuing use of asset and from its ultimate disposal. And next is applying appropriate discount rate to those future cash inflows. Cash flows. In measuring the value in use, estimate of future cash flows shall include A. Projections of cash inflows and necessary cash outflows from the continuing use of asset, and B. Net cash flow from the residual value of the asset. Now, estimates of future cash flow shall not include cash flow from the following: A. Future restructuring not yet committed. B. Improving or enhancing the asset performance. C. Income tax. And D. Finance activities. Also, discount or rate used in present value calculation shall be called pre-tax rate. Recognizing and measuring an impairment loss for cash generating unit. An impairment loss shall be recognized for cash generating unit if and only if the recoverable amount is less than carrying amount of unit. The impairment loss on CGU shall be allocated. First, 10 goodwill allocated to CGU, and then the other asset of the unit pro rata on the basis of the carrying amount of each asset in the unit. In allocating impairment loss, carrying amount of an asset belonging to CGU shall not be reduced below the highest of A. Fair value less cost to sale, B. Its value in use, and C. 0. Reversal of an impairment loss. An impairment loss is recognized for goodwill shall not be reversed in subsequent period. The reversal of impairment loss shall not increase the carrying amount of the asset above the carrying amount that will have been determined had no impairment loss been recognized for the asset in prior years. The gain on reversal of impairment loss is recognized in profit and loss. Section 28. Employee benefits. All forms of consideration given by entity in exchange for service rendered by employees. Employee benefits accounted for under this section includes the following. A. Short-term employee benefits. Benefits that are fully due within 12 months after the end of the period in which the employee rendered the related service. B. Post-employment benefits. Benefits other than termination benefits that are payable after the completion of employment. C. Other long-term employee benefits. Benefits under the post-employee benefits and termination benefits that are due beyond 12 months after the end period. And D. The termination benefits. Benefits payable as result of either 1. An entity decision to terminate the employee's employment before the normal retirement date, or B. Or next is an employer decision to accept voluntary redundancy in exchange for those benefits. General recognition principle for all employment benefits. Cost of all employee benefits shall be recognized. A. Liability. After deducting amounts that have been paid either directly to the employees or as a contribution to the employee benefit fund. If the amount paid exceeds the obligation arising from service before the reporting date, the excess shall be recognized as an asset. B. Expense. Unless the cost is recognized as part of the cost of an asset such as inventories or property, plant, and equipment. Next is short-term employee benefit. This includes the items such as A. Wage, salaries, and social security benefits. B is short-term compensated absences, such as paid annual leave and paid sick leave. C. Profit sharing and bonuses payable within 12 months after the end of the period. D. Non-monetary benefits such as medical care, housing, cars, and free or subsidized goods or service for current employees. And next is measurement of short-term benefits. Generally, employee benefits incurred as a result of employee services rendered during the period shall be measured at undiscounted amount of short-term employee benefits. Recognition and measurement short-term compensated absent. A. Accumulating. Can be carried forward and used in future periods if not used in current period. B. Non-accumulating. To those are not carried forward and are forfeited if not used in current period. An entity shall recognize the expected cost of short-term employee benefit if in the form of compensated absence as follows. In accumulating compensated absence, when the employee rendered the service that increased their entitlement to future compensated absence. B. In the case of non-accumulating compensated absence, when the absence occurred. Post-employment benefits. A. Retirement benefits such as pension. And next is letter B. Other post-employment benefits such as post-employment life insurance and post-employment medical care. Defined contribution plans are post-employment benefits plans under which A. Entity pays fixed contribution. B. Entity has no legal or constructive obligation. C. The amount of post-employment benefit received by the employee is determined by the amount of contribution paid by the entity. Defined benefit plans are post-employment benefit plans. A. Entity obligation is to provide the agreed benefits to current and former employees. B. The actuarial risk, the benefit will cost more or less than expected, and investment risk. The return of assets set aside to fund by the benefit will differ from expectation are borne by the entity. And C. If investment experience is worse than expected, the entity obligation may increase, vice versa. Next, multi-employer plans and state plans, classified as defined contribution or defined as contribution plans or on the basis of the terms of the plan, including any constructive obligation that goes beyond the formal terms. Insured benefit plans, entities shall treat a plan as defined contribution plan unless it has legal or constructive obligation, either A, to pay the employee benefits directly when they become due, or B, to pay further amounts if the insurer does not pay all future employee benefits. Defined contribution plans, recognition and measurement. The contribution payable for period shall be recognized as a liability. After deducting any amount already paid, if the contribution payments exceeds the contribution due for service before the reporting date, an entity shall recognize the excess as an asset expense unless the cost is recognized as a part of an asset such as inventories or property, plant, and equipment. Defined benefit plans recognition. Under a defined benefit plans, an entity shall recognize a defined benefit liability for its obligation under defined benefit plans net of unplanned assets. B. Expense for the net change in the defined benefit liability during the period. Measurement of the defined benefit liability. Measured at the net total of the following amounts. A. Present value of obligation minus the fair value of planned assets. Discounting. The defined benefit obligation shall be measured on a discounted present value basis. Next, actuarial valuation method. The projected unit credit method shall be used in an entity is able to do so without undue cost or effort. The projected unit credit method acquires the measurement of defined benefit obligation on a basis that reflects estimated future salary increases. Defined benefit plan asset. An entity shall recognize a surplus as a defined benefit plan asset only to the extent that it is able to recover the surplus either through reduced contribution in the future or through refunds from the plan. Recognition, accounting policy election. All actuarial gains and losses shall be recognized in the period which they occur, either A. in profit or loss, or B. in other comprehensive income. Reimbursement. If virtually certain that the other party will reimburse some or all of the expenditure required to settle a defined benefit plan. Other long-term employee benefits. Other long-term employee benefits include the following: A. Long service or sabbatical leave. B. Long service benefits. C. Long-term disability benefits. D. Profit sharing and bonuses payable. E. Deferred compensation. Liability for other long-term benefits is measured at net total of the following: A. Present value of the benefit obligation at the reporting date minus fair value at the reporting date of planned asset. Termination benefits. Entity may be committed by legislation, contract, or other agreements with employees, custom, or desire to act equitably to make payments such as payment or termination benefits. Recognition. Entity shall recognize them as expense in profit or loss immediately. Measurement. An entity shall measure at the best estimate. Section 29. Income tax. Includes all domestic and foreign taxes are based on taxable profit. entity is required to recognize current and future tax consequence. This recognized tax amount comprise the following. A. Current tax. The tax payable refundable in respect of the taxable profit, tax loss, for the current period or past period. B. Deferred tax. Tax payable or recoverable in future periods generally as a result of the entity recovering or settling its asset and liability for their carrying amount. The tax effect of the carrying forward of currently unused tax losses and tax credit. A current tax liability is recognized for the tax payable on taxable profit for the current and past period. If the amount paid for taxes exceeds the amount payable, the excess is recognized as current tax asset. Deferred tax asset is recognized for deductible temporary difference including unused tax losses that are carried forward and thus tax credits. Deferred tax liability is recognized for taxable temporary differences, tax bases and temporary differences. Tax base of an asset is the amount that will be deductible for the tax purposes against any taxable economic benefits that will flow to an entity when it's recover the carrying amount of an asset. Tax based liability of a liability, it is carrying amount less any amount that will be deductible for tax purposes in respect of that liability in future periods. Next is temporary differences are differences between carrying amount of an asset or liability in the statement of financial position and its tax base. Taxable temporary differences. It may also arise from timing differences. A. Initial recognition of goodwill. B. Initial recognition of asset or liability in transaction that is not a business combination and neither affects the accounting profit nor taxable profit. Deductible temporary differences. A deferred tax shall be recognized for all deductible temporary differences to the extent that it is probable that a taxable profit will be available against which the deductible temporary difference can be utilized, except when the deferred tax asset arise from the initial recognition of asset or liability in transaction that is not a business combination and neither affects the accounting profit nor taxable profit. Allocation in comprehensive income and equity. Tax expense is recognized in the same component of total comprehensive income or equity as the transaction or other event that resulted in tax expense. Next is current non-distinction. Deferred tax assets, liabilities, shall be presented as non-current assets, liabilities. And Section 30 foreign currency, it referred to counting for business combination.
Section 31 Hyperinflation. This section applies to an entity whose functional currency is a currency of a hyperinflationary economy. So here in Section 31, hyperinflation, it applies to those entities whose currency is a functional currency. An entity who's using functional currency is required to prepare financial statements that have been adjusted for the effects of hyperinflation. This section does not establish an absolute rate at which an economy is deemed hyperinflationary. An entity shall make that judgment by considering all available information, including, but not limited to, the following possible indicators of hyperinflation. Letter A. General population prefers to keep its wealth in non-monetary assets. Letter B. General population regards monetary amounts not in terms of local currency. Next is sales and purchase on credit takes place at prices that compensate expected loss.
The fourth one is interest rates, wages, and prices are linked to price index. Measuring unit in financial statement shall be stated in terms of the measuring unit current at the end of the reporting period. Comparative information for previous periods and information of earlier periods shall also be stated in measuring unit current at the reporting date. So all of the amounts in financial statements shall be stated in terms of the measuring unit current at the end of this reporting period. And in this section, the restatement of financial statements uses general price index. Statement of financial position amounts not expressed in measuring unit current at the end of the reporting period are restated by applying general price index. Monetary items are not restated. Those monetary items are not restated because they are expressed in measuring unit at the end of the reporting period. Monetary items are held to be received or paid in money. Assets and liabilities linked by agreements to changes in price are adjusted in accordance with the agreement and presented at adjusted amount. All other assets and liabilities are not monetary. Some non-monetary items are carried at amounts current at the end of the reporting period. Most non-monetary items are carried at cost or cost less depreciation. Some monetary items are carried at dates other than that of acquisition or reporting date. Restated amount of non-monetary is reduced in accordance in section 27. All amounts needs to be restated by applying the change in the general price index from the dates when the items of income and expenses were initially recognized financial statements. So, all of the items in Statement of Comprehensive Income shall be expressed in terms of measuring unit. In Statement of Cash Flow, all items shall be expressed in Statement of Cash Flow. So, an entity shall express all items in the Statement of Cash Flows in terms of the measuring unit current at the end of the reporting period. Economy ceasing to be hyperinflationary. When an economy ceases to be hyperinflationary and an entity discontinue preparation and presenting financial statement, it shall treat amounts expressed in the presentation currency as the basis for the carrying amounts. Section 32. Events after the end of the reporting period. Events after the end of the reporting period and sets out principles for recognizing, measuring, and disclosing those events. So, events after the reporting period are those events, favorable and unfavorable, that occur between the end of the reporting period. And there are two types of events. The first one is the adjusting events. So, these adjusting events provides evidence of conditions that existed at the end of the reporting period. And the second one is non-adjusting events. These events are those indicative of conditions that arose after the end of the reporting period. Adjusting events after the end of the reporting period. Entity shall recognize in its financial statements. So, following are examples of adjusting events after the end of the reporting period. The first one is the settlement after the end of the reporting period of a court case that confirms that entity has present obligation. The second one is receipt of information at the end of the reporting period that an asset was impaired. Next is the determination after the end of the reporting period of the cost asset purchased or the proceeds from assets sold. The fourth one is the determination after the end of the reporting period of the amount of profit sharing or bonus payments. And the last one is the discovery of fraud or errors that shows that the financial statements are incorrect. Non-adjusting events after the end of the reporting period. So following are the example of non-adjusting events. The first one is a decline in market value of investments between the end of the reporting period and the date when the financial statements are authorized. So the decline in market value does not normally relate to the condition of investments, but reflects circumstances that have been arises. Entity does not adjust the amount recognized in its financial statements for investment. The second one is the amount that becomes receivable as a result of favorable judgment or settlement of a court case after a reporting date but before financial statements are issued. So this would be contingent asset at reporting date and disclosure may be required. Non-adjusting events after the end of the reporting period. An entity shall disclose the following for each category of non-adjusting event after the end of the reporting period. The first one is the nature of the event. And last, an estimate of its financial effect or a statement that such an estimate cannot be made. The followings are non-adjusting events that would generally result in disclosure. The first one is major business combination. Second is announcement of plan to discontinue the operation. Third one is major purchases. The fourth one is destruction of major production plant by fire. The fifth one is announcement of major restructuring. The next is issue of entity's debt or equity instrument. Next is abnormally large changes in asset price or foreign exchange rates, changes in tax rates or tax laws, entering into significant commitments, and the last one is commencement of major litigation. Section 33. Related party disclosure. Related party is a person or entity that is related to the entity that is preparing financial statements. In this section, the entity is required to include disclosure in its financial statements to draw attention to the possibility that its financial position and profit or loss have been affected. The followings are not necessarily related parties. Two entities simply because they have a director or other member of key management in common. Two ventures simply because they share joint control over a joint venture. Any of these following. First is providers of finance. Second is trade unions. Third, public utilities and government departments. And letter D is customer, supplier, franchisor, distributor, or general agent. Disclosure of a parent-subsidiary relationship. An entity shall disclose the name of its parent and, if different, the ultimate controlling party. So the relationships between a parent and its subsidiaries shall be disclosed irrespective of whether there have been related party transactions. Disclosure of key management personnel. Compensation. Key management personnel are those persons having authority and responsibility for planning, directing, and controlling the activities of the entity, directly or indirectly, including any director. Disclosure of related party transactions. Related party transactions is a transfer of resources, services, or obligations between a reporting entity and a related party. Example of related party transactions that are common to SMEs include but are not limited to: A. Transaction between entity and its principal owner. The next one is transaction between entity and another entity. And the last one is the transactions in which an entity or person that controls the reporting incurs expenses directly. If an entity has related party transactions, it shall disclose the following. First is the nature of the related party relationship. Second is information about the transactions and their amounts. The next one is the outstanding balances and commitments. And the last one is provisions for uncollectible receivables and bad debts expense recognized on such receivables during the period. Following are examples of transactions that shall be disclosed if they are with related party. First is purchases or sales of goods. Next is purchase or sale of property and other assets. The third one is rendering or receiving of sales. Next is leases. The next one is the transfer of research and development, transfer under license agreement, transfer under finance agreement, provisions of guarantees or collateral, settlement of liabilities, and lastly, participation by a parent or subsidiary in a defined benefit plan. Section 34. Specialized activities. This section shall be applied by SMEs involved in three types of specialized activities, namely: first is agricultural, second, extractive activities, and the third one is service concessions. Agriculture. An entity adopting the PFRS for SMEs that is engaged in agricultural activity shall determine its accounting policy for each class of its biological asset as follows. The first one is fair value method. In fair value method, an entity shall measure biological asset on initial recognition. The second one is cost model. In cost model, an entity shall measure at cost less any accumulated depreciation and any accumulated impairment losses. Recognition. Biological asset or agricultural produce shall be recognized when an entity controls the asset, it is probable that future economic benefits associated with the asset will flow to the entity, and lastly, fair value or cost of an asset can be measured reliably. Section 35. Transition to the PFRS for SMEs. This section applies to a first-time adopter of the PFRS for SMEs regardless of whether its previous accounting framework was full PFRS or another set of generally accepted accounting principles, such as its national accounting standards or another framework such as the local income tax basis. First-time adoption. A first-time adopter shall apply this section in its first financial statements that conform to the PFRS for SMEs. An entity is required to disclose in a complete set of financial statements comparative information. Well, the financial statements prepared in accordance with the PFRS for SMEs are an entity's first such financial statements if, for example, the entity did not present financial statements for previous periods. And the second one is presented its most recent previous financial statements under national requirements that are not consistent with the PFRS for SMEs in all respect. Or lastly, presented its most recent previous financial statements in conformity with full PFRS. The following are procedures for preparing financial statements at the date of transition. An entity shall, in its opening statement of financial position as of its date of transition to the PFRS for SMEs, first, recognize all assets and liabilities whose recognition is required by the PFRS for SMEs. Second, not recognize items as assets or liabilities if the PFRS for SMEs does not permit recognition. Third one is reclassify items that it recognized under its previous financial reporting framework. And the last one is apply the PFRS for SMEs in measuring all recognized assets and liabilities.